CVS just reported earnings and it's down another 3 or 4%, I believe. In total, it's down around 7% since I made my video. And I said CVS was undervalued below $75 per share. And many of you wrote me in the comments, can you give us an update, on the stock? And you just have to remember something, that whenever I say a stock is undervalued, it doesn't mean that I'm trying to call the bottom on it. I'm just saying that the stock is undervalued. Now, it doesn't mean that the stock can't get more undervalued in the future. It could get cheaper, or we could actually be wrong on the thesis and maybe we actually overpaid for CVS at $75 per share. So I'm going to do another discussion on CVS, talk about some recent things that happened and my own valuation model, and just give you an update on it in general. Now, if you look at the chart of CVS since 2018, it's a pretty ugly chart. It's back to the same price it was trading at in 2018. Now, I highlighted something here in 2018 to early 2019. This is when CVS acquired Aetna, the insurance company, over $69 billion. They took on, I believe, around $50 or $60 billion of debt, and they actually diluted share for them to get more, interest and more, exposure to actually the insurance industry, which is a very profitable industry. So they closed on Aetna on $69 billion. When that happened, CVS sold off around 36.5% from the top to the bottom in 2018. Nothing has changed, nothing has happened, but only because they acquired Aetna, and there was a lot of uncertainty around the acquisition, and the market hates uncertainty. It hates whenever you're borrowing $50 billion to do an acquisition. Maybe you're overpaying, maybe it's not going to work out, maybe CVS is not going to know how to actually run Aetna, and there was a lot of fear and a lot of uncertainty around this, so the stock sold off 36.5%. Now, they did take on a lot of debt, and the market has the right to actually worry about those things. Now, let's look at what happened since 2018. Since 2018, CVS had net debt around $81 billion. This debt went from $81 billion to $55 billion. So this would show us that CVS actually has a good track record of paying down its debt after they do those acquisitions. They borrow money, they did the acquisition, they took the free cash flow, and they repaid down the debt. So this is something good we're seeing from the management. Something else that we could see that has happened that's actually good is the EPS growing. From 2019, the EPS was $7.08 per share. In 2023, it's $8.70 per share. So this would actually show us that maybe CVS is doing something right with this acquisition that they did with Aetna. They grew EPS, they repaid the debt, and the free cash flow for the company more than doubled. It was $6.8 billion in 2018. Now it went pretty close to $15.5 billion in 2021. Now it's around $13.50 in 2022. It went up a lot since 2018, which again would show us that CVS is actually, might be doing something right with those acquisitions, and they are, they know what they're doing. Now we look back now at 2023, the stock also sold off 35.5%. Why? Because they also have new acquisitions. They borrowed $20 billion, or I believe $15 billion to do two acquisitions that are actually unprofitable. And there's a lot of uncertainty again, just like what happened with Aetna. There's uncertainty right now that these companies are unprofitable. Maybe CVS overpaid. CVS has too much debt. Some people are saying CVS is going to go bankrupt, like, Bed Bath & Beyond, which is a stupid argument, but there's a lot of bad sentiment around the company, a lot of haters, a lot of short sellers, a lot of trolls, a lot of shareholders that are worried, and there's just a lot of things which I'm going to address in this video. But these are the acquisitions that CVS made. The first one is Oak Street Health, and they have around 169 medical centers, and they're trying to get more into the primary care, type of space, which they're going to have a vertically integrated platform from the pharmacy care and the prescription drugs to the insurance company, which is Aetna, and now also primary cares, and they are also trying to get exposure to home health, providement and stuff like that. And this is something that CVS has been talking about for years, and they finally pulled the trigger. Now there's a lot of uncertainty again that CVS has too much debt, CVS maybe overpaid, CVS did all those things, but all those worries were the same since 2018, and we saw what CVS did since 2018. They actually repaid the debt. They were good with it. They did not go and do another acquisition the next year. They took the free cash flows they got, and they started repaying down the debt. They grew EPS per share. They more than doubled the free cash flow. So the market is doubting, the management, which actually showed them a good track record of doing the right thing. And now Aetna is actually something, unique that CVS has, and it sets it apart from other, companies like Walgreens. And because of all this uncertainty, the business is fine. The revenue, it grew 11%. Things are good with CVS, but the stock is now trading around 7.9, almost break even at 8 times earnings for the company. Now, just a few months ago, before they announced those acquisitions, CVS was trading around 11.5 times earnings. It went from 11.5 times to now it's touching 7 times earnings, high 7 times. Why? Because CVS has too much debt. They acquired these companies. There's a lot of uncertainty. Sell the stock. They don't know what they're talking about. And all these kind of things, even though the management showed us a good track record of doing the right thing. But maybe this time they overpaid. And I believe they might have overpaid for an unprofitable company. But CVS mentioned that they're not going to do any more acquisitions. They are done. They built the platforms they were trying to build, from the insurance company Aetna to the primary care of Oak Street Health. So now no more acquisitions. They're going to focus on bringing the debt down, just like they brought it down whenever they did Aetna, from $81 billion of debt to $55 billion of debt in total. Now, looking, at the balance sheet, which is the main worry, is the debt. CVS is going bankrupt, and, just the debt in general. And people just look at the total debt. I mean, if you look at the total liabilities, $167 billion. This is too much debt. You don't buy CVS immediately. But they don't even dig in a little bit deeper of actually, looking at the debt maturities, all these kind of things. Now, we looked at the debt maturities, but now we're going to talk about if the debt is actually manageable. These are the things I look at. Now, they have cash and cash equivalent of $14.5 billion. Now, I have to be honest, I think this will be used to fund part of the acquisition with Oak Street. I think they're going to use 10 or 11 billion. So I would not count a lot on the cash and cash equivalent, but we're going to talk about it in this video. So $14.5 billion of cash and cash equivalent. They have long-term debt of around $56 billion. Now, in total, this is, somewhere around, pretty close to $42 billion of long-term debt. Now, you could also add other liabilities. They have other insurance liabilities, $5.6 billion, long-term liabilities, $6 billion. In total, it's somewhere around 55, let's say $60 billion of debt. Now, that's a lot of debt, $60 billion. And some people, again, they go and they count the operating lease activity. They said CVS has $75 billion of debt, which is actually not true, because I personally don't count the lease liability. The lease liability wasn't even on the balance sheet. It was just put up, I believe, in 2019 or in 2020. It's actually something new. And this is something they don't pay interest on. So I personally don't count it within the debt. It's something, they have to pay it anyway. It's the cost of doing business. So I don't count it within the long-term debt. But just to make a very, simple assumption and say CVS has around $60 billion of debt. Now, let's look if the debt is actually manageable. It might be a little bit less than $60 billion, but we're just, for the sake of the argument, we're getting $60 billion of debt. Now, $60 billion of debt, all right, they have around $13 billion of cash from operations. This is the recent guidance. They have capital expenditures of around $3 billion on the high end. If you take the capital expenditures off the cash from operation, you end up with $10 billion of free cash flow. Now, they have commitments such a dividend. They do pay a dividend. It's somewhere around $3 billion. Now, they have $10 billion of free cash flow, $3 billion they pay every year as a dividend. This is $7 billion of extra free cash flow that they can use to pay down debt. Now, even if the debt is $60 billion on $7 billion of yearly extra free cash flow, which can actually grow in the future based on a lot of things that CVS is doing, I don't think the debt is as bad as people are talking about. $60 billion of long-term debt is a lot of debt, but $7 billion of free liquidity that they can actually use to pay down this debt will actually make the debt not as bad as it actually seems. They could take 8 or 9 years and just be issuing the dividend, growing everything organically, and just paying down that they can wipe out their entire debt in 8 to 9 years. So I don't think this is as bad as people are saying. I don't think CVS is going bankrupt like some people, claim on the message boards, and all these kind of things. I think the debt is high, but it's actually more manageable than most people are actually talking about. Now, something I didn't like on the earnings call is they said they are facing some short-term headwinds as they might not be able to get to $10 of EPS by 2025. They said they are still committed to getting to this target, but maybe they might not be able to because of some short-term headwinds, which might be offset by the cost synergies they're gonna get whenever they bring in Oak Street Health and Signify Health. Now, CVS would have already been at $9 per share of EPS if there was not a 30 cents impact per share because of the loss from Oak Street and Signify, because they are still losing money and they haven't done the synergies yet. But their target is $9 of EPS in 2024 and $10 of EPS by 2025. Now, we talked about the PE ratio of CVS just dropping down like crazy. It was trading before at a mean of 10 times earnings. It traded as high as 13 times earnings over the past years, and now trading as low as 7 times earnings. Now, I'm not saying CVS is gonna go back to 13 times earnings. I'm not gonna say CVS is gonna go back to 21 times earnings where it was trading in 2015. I believe most of us can agree that if CVS over the next 2 years, they show a good track record of paying down the debt, they show the synergies from Oak Street and Signify, if there's less and less uncertainty with the company, maybe the stock could trade back at 10 times earnings. And immediately people will tell me, yes, but you're just making guesses and you're just making assumptions. Well, there's no certainty in investing. There's nothing that's going to tell you for certain this is how much it's going to be. It's all about making an educated guess and being on the safe side, not on the high side. And the safe side for CVS, in my opinion, is a 10 times earnings, type of multiple. So instead of getting to $10 by 2025, if they just get to $9 by 2025, and some of the uncertainty goes away, and CVS trades at 10 times earnings, this is $90 per share, and this is the safe, bet, in my opinion, without even factoring in the 3.5% dividend, which you're going to get, while you pretty much wait for the value to be, realized with CVS. Now, something much better could actually happen where CVS could reach the $10 of EPS by 2025, and maybe CVS trades back at 12 times earnings where it was trading in January. If that happens, then CVS could be trading at $120 per share in the next year and a half or 2 years, which is massive upside from here, not counting the 3.5% dividend. So there's a lot of uncertainty around CVS. I'm not sure how low it could go. The chart is scary if it doesn't find, some support here. I mean, I don't know, it could go $60 per share, $62 per share. I'm not trying to really just go and say, this is where the bottom, this is where we should buy. I believe CVS is undervalued, and, it's a good buying opportunity at such prices. I gave you my case. I gave you some of the risks, some of the balance sheet stuff, and the things that's happening. You could do your own assessment and try to come up with your own conclusion if CVS, is a good buying opportunity or not. I believe it's undervalued. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.